All right, let's get to the first moves after the open. We're joined by George Tsilis. Very good morning to you, George. So we're looking at the reaction this morning, first and foremost, to Qualcomm, which we broke yesterday. As I said, not a bad report. It almost feels like, though, the street thinks that this is going to be a 2026-2027 story. Tell me if I'm right.
Yeah, I suggest you're right. If you look at the breakdown for Qualcomm, really what's going on with the business is how are they going to diversify away from Apple? And that's still perhaps an ongoing process that may move it into the next year or even the year after that, as you mentioned. But if you look at the breakdown, it was actually quite good in terms of EPS, $3 a share versus the 287 estimate. That was higher by 14% compared to the same quarter last year, where the company earned $2.69. Revenue came in $11.27 billion, up 10%, beating the estimates by about $510 million. So it was quite a big beat compared to $10.24 billion last year. But if you look at the breakdown of their licensing revenue, which again includes the technology IP associated with Apple mostly when it comes down to those sales, that segment was down 7.4%, offset by their CDMA, or if you will, QCT revenue or technology revenues, which were higher by 18%. So there was some offset, but there was also some give back in the licensing. And I think it really comes down to they are making progress in the end market diversification. You know, they had recent good news in data centers and AI infrastructure chips. But again, losing the Apple business over time is still going to be an anchor on Qualcomm. But nonetheless, they're making progress. And it's kind of a situation where we see the stock perform poorly, at the margin right now, based on some really good news.
Yeah, that's right. I mean, we've seen this earnings season. Even if you clear the bar, it's not always enough as far as the street is concerned. So a few other things going on there. I'm just looking at also the performance of CarMax this morning, getting punished in the session, 13% lower. Can you speak to the performance there off the back of what we've heard from that company and also the fact that we're seeing the CEO, Bill Nash, stepping down too?
Yeah, so we're basically seeing a transition of power at CarMax. One of the things that's been going on, if you go back to September, they guided quite a bit lower in terms of EPS. The stock took a hit, and now they're actually making an additional adjustment in terms of earnings expectations coming up for the next quarter. So last quarter, they posted about 64 cents, and of course, they cut now another 9 cents off an adjusted basis and widened the range to between 18 and 36 cents. So that's effectively half of where they were last quarter. They're also seeing comp sales for the quarter to be down 8 to 12%. And again, they're looking at these additional charges associated with restructuring costs. They're going to be laying off some workers, cutting back their experience center. These are factors that they mentioned in their last results. But nonetheless, they did again post some auto sales. At least EV sales were higher because of the expiring tax credits by 6.4%. September versus August. But if you look at effectively the wholesale used vehicle market, prices have been falling, and total sales September versus August were down about 2%. So volume is down, prices are down. That's not a good sign. And of course, the restructuring charges added to that are putting pressure on CarMax this morning again.
Right, and you're looking also at Fortinet this morning, which is also lower on earnings. Can you talk us through that report and the reaction you're seeing today?
Yeah, let's take a look at the price on this one. But yeah, so this one's interesting because it's a cybersecurity name. And if you look at the EPS numbers they posted, 74 cents higher than the 63 cents. So that was 17% increase. If you look at the top line sales, 1.72 billion, 14% higher. They also beat the estimates fractionally by about 20 million. The challenge is their targets essentially about 14% in terms of sales for next quarter. And of course, not for the full year, they see expanded AI solutions. But one of the things is, if you look carefully, the next quarter revenue range was actually widened out to 1.83 billion to 1.89 billion, where the estimates were 1.88 billion. So in other words, they widened out the range of next quarter's revenues, the low end of the range. And so that's essentially putting pressure on the shares.
Okay, looking across three key names this morning off the back of earnings and the reaction in the market today. Thanks so much for that, George Tsilis. I'll talk to you a little bit later on.